Welcome to Trading Nation. I'm Mike Santoli. Fed members expected to agree upon a rate cut at their July meeting, but the central bank's path beyond that still uncertain. Our next guest has a way to hedge whatever the next move. Let's bring in Chris Zaccarelli. He is Chief Investment Officer at Independent Advisor Alliance. So, Chris, I guess two-stage question here. What do you expect specifically out of the Fed this week? And then how would you expect the markets to absorb that move?
Sure. Well, tomorrow we're expecting a 25 basis points rate cut. That's pretty much locked in. Around 80% of the market believes that's what we're going to see tomorrow. It is possible they could do 50 basis points and surprise us, but that's not our belief. I think they will stick with 25. Now, going forward, the question is just really how the Fed is going to communicate that. I think they're going to do that first rate cut, then look to see for the future where they can cut again, depending on how things shake out. So they're definitely looking at inflation, they're looking at growth, and they're looking at trying to do this insurance cut in order to just get ahead of potentially trade weakness and what all the rest of the other central banks are doing. So if the Fed cuts 25 basis points, I think that's largely priced in. You won't see much of a reaction. If they cut 50 basis points, I think the initial reaction could be a little bit steeper. You may see a quick jump in the market, and then eventually I think the market may get a little bit more concerned. And over the medium term, I would say that could be a negative, actually.
All right. Now, I think the textbook way to play when the Fed starts cutting rates might be to turn toward some cyclical stocks, whether, housing, autos. That seems to be the very traditional playbook. But this hasn't been necessarily the most traditional run-up to an initial rate cut in terms of how the markets have acted. So how would you look to act on this, to play this? What areas of the market would you emphasize right now?
Okay, well, again, all things being equal, if you're cutting rates and that's better for cyclical stocks, to your point, on the other hand, you could watch out for what could potentially be an upcoming recession. And if the Fed is really cutting rates in advance of what could be some weakness in the economy coming forward, then typically people will go to utilities and consumer staples. Unfortunately, right now, both of those sectors are pretty expensive. You've got utilities trading around 18.5 times earnings, consumer staples around 19.3 times next year's earnings, whereas the market as a whole is more around 16.5 times next year's earnings. So both of those defensive sectors are a little bit more expensive. So what we're looking at doing is going into healthcare, which is also a defensive sector. It's much cheaper than those other sectors I mentioned. It's trading around 14.5 times earnings. And within healthcare, you really can have an opportunity for both growth as well as defensive sub-industries, subsectors. So looking at biotechnology, that's really the growth area of healthcare. And if you look at earnings that have been reported so far this quarter, over 50% of the S&P 500 is reported, around 60% of healthcare companies are reported, and you're seeing biotechnology coming in around a 12% earnings growth. That's really good compared to the rest of the market. Meanwhile, if you look at medical device manufacturers and services companies within healthcare, it's growing at a slower rate, around mid-single digits growth, but it provides much more defensive characteristics. So we believe that at 16.6 times earnings, quite a bit cheaper than utilities or consumer staples. Within healthcare, you can look at medical device manufacturers and services as a way to play that defensive trade without necessarily paying as high a valuation as those other more typical defensive sectors.
And implicit in that, in those two areas that you mentioned within healthcare, is I guess that the health insurers and big pharma don't have as much appeal, even though maybe they look kind of cheap.
Yes, the whole sector looks inexpensive no matter where you look, but I think those insurers definitely are dealing with some headwinds in terms of the political fallout of both sides of the aisle, Republicans and Democrats, looking to potentially control costs, and so that could potentially hit margins down the line. So I would look in those growth areas like biotechnology or medical device manufacturers, which we believe will be less impacted by some of these cost controls as your traditional pharma or insurers, as you pointed out.
All right. Well, we'll see how all that plays. Appreciate it, Chris. Thanks for your time.